Well, good morning, everyone. Thank you for joining us today for our latest webinar, Adopting Thematic Investing in Client Portfolios. My name's Blair Modica, and I'm really looking forward to having a discussion around how we think about thematic investing and how we can implement these strategies in portfolios. So we've certainly seen a large increase in the amount of interest in thematic types of ETF exposures, particularly over the last couple of years. And we feel that there's significant demand to develop the thematic investment ecosystem and make relevant investments available to financial advisors and their clients. So just a quick note on this presentation, all information provided is general in nature and does not take into account any person's financial circumstances. And before we kick off, I just wanted to make you aware that we'll be recording this session and a copy of the presentation will be made available at the end of our national roadshows later on in March. We'll certainly send out the CPD accreditation points at the conclusion of the webinar today. And lastly, I'd like to encourage as many questions as possible throughout the webinar. We want to make it as interactive as possible, and we'll be hosting a live Q&A at the conclusion of the slides. No question is a silly question, and we'd love to continue the conversation. I briefly wanted to touch on BetaShares more broadly. We now have 69 different investment solutions available, the newest of which we'll cover today. For those that are new to BetaShares, we've been around since 2009 and manage around 23 billion in funds under management. We're the only Australian founded and managed ETF provider, and that's important for a couple of reasons. One, no paperwork when investing in overseas markets, and two, all of our investments are designed with the Australian financial practitioner and end client in mind. So we do not take any existing overseas strategies and hope they fly within the Australian market. It's purely designed for the Australian investor. We're more than happy to provide members of our investment committee and portfolio management team to you and your clients for any questions or any other conversation that you may need. Just please reach out and let us know. And joining me today is my colleague, Cameron Gleeson. Cameron's a senior investment specialist within our business and is well equipped to discuss megatrends and the implementation of thematic investments in client portfolios. He'll be covering the bulk of today's session, and he works across the portfolio management and distribution teams and certainly assists a lot of our advisor clients with portfolio construction implementation. So today I'll be talking about why thematic investing, and Cameron will be covering how the thematic investing is different, thematic ETFs in portfolio construction, and some of the exciting new thematic ETFs that are coming to fruition very shortly. So firstly, I thought we'd touch on why thematic investing, and thematic investing is increasingly attractive because it provides long-term exposure to powerful and persistent themes that are transforming our planet and daily lives. And if we just move to the next slide, incorporating thematic investing into portfolio construction really offers a number of key advantages. The first we think is thematic investing provides access to long-term above market growth opportunities. And the primary objective, of course, is to generate outperformance over broad market benchmarks, or what we call alpha. So given this outperformance potential, we've seen an increasing number of advisors replacing high-cost active managers with thematic ETFs, providing more choice and control as to which structural growth opportunities they wish to include in client portfolios. And indeed, replacing an active manager with a low-cost passive or smart beta strategy can have profound impact on the overall return outcome for a client. As Cameron will touch on in more detail, businesses leveraging structural growth tend to be less sensitive to the broader business cycle, and this can be advantageous when economic conditions deteriorate. The COVID crisis over the last couple of years is a really good example of this. And indeed, investing in themes allows an investor to access sectors which may be traditionally underrepresented within their core holdings. So this certainly is something Australian investors can identify with, as the core of the Australian market is really made up of financials and resource companies. So taking positions in thematic funds can encourage a diversified portfolio. And from an advice point of view, having quality options to take to clients will resonate well with their own personal interests and may represent an opportunity to engage with the client and achieve optimal outcomes at the same time. So as a client's intellectual and emotional connections to themes have strengthened, thematic funds are increasingly becoming a part of investors' thinking. And so the story behind the growth in thematic investing is really reflected by strong demand. And you can see the chart on the screen from Morningstar shows the total asset under management in thematic funds globally, both passive and active. And you can see that the uptake has been particularly strong, especially over the last couple of years. Morningstar's found that thematic investing is the fastest growing investment approach over the last year, and that's really showing no signs of slowing down. So from the chart, you can see that Europe is the largest market for thematic funds, and that accounts for about 51% of global thematic fund assets, up from 10% in 2001. While all regions have experienced net inflows over the trailing 3 years, Europe and the US, perhaps unsurprisingly, have been the main beneficiaries, so netting 141 and 87 billion in net flows over the period, respectively. Again, interestingly, in the US, 63% of thematic fund assets are passively managed, and this really reflects the success of the thematic ETF landscape in the region. And if we look at Australia, and given Australia tends to take its lead from the US in terms of ETF progression, it stands to reason that the next few years will see a large growth in thematic assets in Australia, up from the 6 billion in the market today. So I'm now going to hand over to Cameron, who will identify three key megatrends and the opportunity that presents itself at this time. So thanks, Cameron. Really looking forward to having a discussion.
Thanks, Blair. Great to be here. Look, before we talk about the thematics in detail and investing in thematics, as Blair mentioned, we want to talk about what are those structural forces that really create these opportunities. Technology, demographics, and climate change are three megatrends that are creating disruption and evolution in the way we organise society and interact with the environment. These are very long-term, broad-based forces. And what's really interesting, though, is that while they are broad-based, from an investment standpoint, they do tend to create very specific investment opportunities. Our view is that these megatrends create investment opportunities either through a single megatrend, so exposure to technology, or, for example, in combination of multiple megatrends driving a particular theme. We'll start with technological innovation. This is arguably the most important, far-reaching megatrend in terms of creating thematic investment opportunities. Innovation can upend existing industries seemingly overnight, create new business models, new efficiencies, and in doing so, create wealth or economic value. We do, however, see that with the speed of technological change, this can often result in resistance from incumbent players. The nature of demographics and climate change is a little bit different in that these megatrends tend to be much more slow moving, and also in isolation, they typically result in a wealth shift rather than wealth creation. So where we see some of the strongest thematic opportunities is in fact at the intersection of multiple megatrends. So take the example where technology is solving a demographic or climate change challenge. Think electric vehicles. The incentive is provided by climate change and the means is provided by technology. Now, traditional investment approaches have tended to focus on the economic cycle, which we refer to as cyclical investing. I want to talk about how thematic investing is different. If we think of the economic cycle, that typically plays out over the short to medium sort of term. It's relatively repeatable. Cyclical investing is normally implemented through investing in established companies and industries, typically filtering on GICS sector codes. We're normally looking at historical relationships between economic variables and divining the right place to be in the market based on our view of the upcoming economic cycle. So if we think, for example, about a recessionary environment, historically, global healthcare stocks have tended to provide some buffer within the equity market in that sort of environment. When we move to that early cycle recovery, we typically see yield curves start to steepen, and we know that banks traditionally have benefited from a steeper yield curve environment. And then as that recovery continues, commodity prices tend to increase, and that obviously is to the benefit of companies, for example, global energy stocks. And I show here three ASX codes for three sector ETFs that we have that offer exposures to those particular areas. Thematic investing, which is leveraging structural change, is fundamentally different in its approach. We're sector agnostic. We seek to take an unconstrained approach to building an investable universe of stocks which have relatively pure play exposure to that theme. We're also very much forward-looking rather than backward-looking and taking a long-term view beyond the economic cycle. Typically, businesses which are benefiting from structural growth are less leveraged in terms of their earnings to the economic cycle. And so this also is helpful in terms of timing our investments. It's less critical what part of the economic cycle we're actually entering into our positions at. So I do want to make the key point though. Thematics are unquestionably growth exposures. This is a really good example just of two stocks, the difference between a cyclical and a structural growth business. This is the revenues of Microsoft and ExxonMobil over a 20-year time horizon. These are quarterly revenues. So for Microsoft, so we do see a little bit of seasonality in those quarterly earnings, but overall it's a pretty steady compounding rate of growth. So in fact, its revenue, really hasn't been adversely impacted by any of the various economic crises we've had over this 20-year period. And the rate of growth last year of revenue was 18%. And almost unsurprisingly, the forecast rate of growth for 2022 is in fact 18%. Now, the cyclicality in Exxon's revenue is obvious. The difference here is that Microsoft is participating in new markets that are growing. Enterprise, cloud, gaming. We know that adoption of these products is growing, and that's creating a larger addressable market, creating that sort of tailwind that we see. Whereas ExxonMobil's industry is just essentially at maturity. So its influences are the size of the economy or economic growth, and obviously geopolitical tensions. So generally, it depends on the economy to grow to see growth in earnings, and sometimes the economy shrinks, and then we see that falling earnings as shown on the chart here. Now, in talking about thematic investing, I don't want to be tone deaf to what we've seen in the market for growth stocks within January, where we saw them sell off, and thematic exposures are fundamentally growth exposures, and they generally suffered the same fate in January. But what I want to do is look at the cause of that correction and sort of the nature of stock price returns for these sorts of exposures. Stock price returns can be decomposed, as shown on the slide there, into changes in earnings over time or earnings growth and changes in valuation multiples. You'll often hear for economists, for example, Dave Bassanese, talk about these as drivers of equity markets. Now, what happened in January wasn't that the earnings outlook of these growth stocks collapsed in aggregate. Their businesses really were very, very much unchanged. What actually occurred was that the market changed the valuations it ascribed to these businesses due to rising bond yields and change in risk sentiment. So we see as a result a shift in the valuation multiples, and that is what impacted stock prices. Now, people talk about growth stocks being expensive. Typically, when we're talking about stock valuations or stock multiples, we're typically talking in multiples like the price to earnings multiple, which is a ratio of earnings to the current stock price. And we're talking about current year earnings. When you buy a stock, you're not just buying the current year earnings, you're buying all future years' earnings. So if we have a stock that we know is expected to grow its future earnings very strongly over time, it makes sense that we're prepared to pay a higher multiple on today's earnings for that stock. So, we know that growth stocks, it's logical that they should be more expensive. And we know that growth stocks have sold off, their valuations have reduced over the last month. And this sort of bears the question, well, where to now if I'm looking to invest? Is this the right time? Look, part of that answer really depends on your investment time horizon. And I said before that earnings growth and valuation multiples drive stock prices. But the relative contribution of these two factors very much depends on that time horizon. So what we've showed here is some work we did just decomposing returns of the S&P 500 over a 31-year time horizon. Now, the pie chart on the left of the screen shows the relative contributions to annual calendar returns from earnings growth, which is just over half, and valuation changes, 43%, so just less than half. So both valuation changes and earnings growth are significant in terms of driving stock price returns over that 1-year time horizon. But what we find is that generally, as we expand that time horizon, we lengthen our investment time horizon, earnings growth tends to dominate. So on the right-hand side, we see the contribution over the entire investment period. We see that earnings growth contributes 91% of the overall change or the stock price appreciation over that time period. So that's really quite powerful, and it's also quite explainable. Earnings tend to compound over time. So as you lengthen your time horizon, you're going to see more of that compounding effect. Whereas valuation multiples are driven by discount rates and investor sentiment. And investor sentiment is certainly mean reverting, and discount rates to some degree are also mean reverting. As you expand your time horizon, you tend to see that reversion for the mean. So the impact of valuation changes is less important. Our view is that you should be looking to invest in thematic exposures as a long-term investment rather than a tactical bet based on valuations. So if I'm looking at this from a long-term time horizon, if I'm looking at thematic exposure, the most important thing for me that I want to be certain on is certainty on that growth rate of earnings, certainty that this set of companies will be profitable and grow strongly into the future. That is key. So one, that's all, very interesting in terms of current state of play, but I guess it comes to the question as to, well, how do I actually implement thematic exposures into my portfolio? And we get this question a lot at BetaShares. Our view is that thematics are best placed to be used as a satellite exposure to replace high cost active managers or single stock positions, which have a lot of stock specific risk. And that's certainly what we've seen across our client set from high net wealth through to retail in terms of implementation. What we find is that thematics can add some diversification and risk mitigation benefit, but the key objective, as Blair mentioned, of thematic investing is to drive outperformance or alpha. So that's the reason why we think they're useful in the satellites. We think that the best way to build a portfolio is low cost core, broad market core exposures, low cost broad market, and also factor or smart beta exposure, concentrating on low cost within the core, and then we can use satellites to add out performance potential. Typically what we see with thematic ETFs is that they are higher volatility than those broad market exposures because they have that theme specific risk. But what's interesting is that theme specific risk often has a lower correlation to those broad market exposures. So when appropriately sized and used as a satellite, they can really blend well and add potential for improvements in risk adjusted return outcomes. And we'll touch on an example later on, but this is sort of an illustrative example of what a high growth investor might look at in terms of building a portfolio of core Aussie and global equities with 10% allocation to defensives. And I've shown here 3 of our ETFs: Drive, which is electric vehicle exposure, Earth, decarbonisation, hacks, cybersecurity, scattered around the outside in satellites, adding a 12% allocation across these themes. Our philosophy, and when we actually look at creating thematic exposures, the first thing we do is we want to know that the theme has the right characteristics. In our view, longevity is key. Is the structural change going to play out, ideally over decades, but certainly over the long term? Secondly, and this is really crucial in building an ETF, is there a liquid market of numerous companies that are adequately exposed to this theme? So we want to have publicly traded stocks that have good liquidity and are relatively pure play so that their price performance is going to be dependent on the growth in the theme. And then finally, what's also very important is the ability of those companies to monetize the theme. Quite often early on in a structural theme, the profitability isn't as high because companies are obviously trying to grow their business and they're investing for growth. But we need to see that there's ability for network effects, product differentiation, or competitive advantages to create profitability opportunities later within that particular development of the theme. So once we've found that thematic investment opportunity that we like, then we embark on creating that thematic ETF. And the index construction can very much depend on the industry, the theme, the companies involved. It can be very much a case-by-case basis. We've got different approaches that we use. But broadly, we believe in passive rule-based approaches to investing in thematics. We focus on pure play exposure. We seek to diversify stock-specific risk. So we want to avoid that, risk to individual names because that stock-specific risk tends to be higher in more embryonic industries. We want to seek exposure to the theme as a whole. And we seek to ride momentum, that winner-takes-all dynamic. It's very important in terms of driving returns. I've got a chart here which is taken from a study of stock price returns, and this is sort of quite good at illustrating the winner-takes-all dynamic, and it's something which is becoming increasingly prevalent in equity markets today, and why thematic ETFs are ideally placed to benefit from this trend. So we typically think about stock price returns as sort of normally distributed, with half the stocks underperforming the index, half the stocks outperforming the index. But in actual fact, when you look at very long-term stock price returns, we see a very large skew in returns. And as shown on the chart here from the study by Bessenbinder, he found that of the performance of US equities over a very long time period, the cumulative outperformance above the risk-free rate was attributable to only 4% of the stocks in the entire index. The majority of stocks, in fact, underperformed the risk-free rate. Now, that's very interesting when we're thinking about investing and the way that wealth creation happens, and we see a concentration in that wealth creation. So where there is an emerging industry undergoing growth, picking those winners is in fact quite difficult, and the chances of failure are in fact quite high for the peer group as a whole. But for the few winners that take that lion's share of market, that are able to create return on investment, abnormal returns tend to compound and be very strong. Now, this is tricky for an active manager who tends to hold more of a high conviction portfolio, try to pick the winners themselves, because the dynamic is sort of skewed against you. You either have to be very skillful or very lucky to pick the handful of winners. Otherwise, if you miss a few of these names, your portfolio will underperform due to the laggards at the bottom of the tail. So, our view is take a market cap weighted approach. You will tend to participate in winners as their size grows through that market cap weighting, and you'll downweight the losers over time. You're benefiting from momentum. This is an approach that venture capital has been exploiting for some time to access growth exposures in their particular market. They take many bets. They expect most of those bets to lose, but they know that those losses will be underwritten, and in fact we'll see positive outcomes from the very few winners within their portfolio that have positive growth. So we think that's very important and an excellent example of why thematic ETFs make sense. BetaShares has the broadest range of thematic ETFs available on the ASX, and you can see the themes covered within our suite shown here on screen, together with their ASX codes. We've also color-coded each of these to indicate which of the underlying megatrends, so technology, demographics, or climate change, each of these themes is leveraging. So included in here will be some familiar names that we've had on our books for a long time, but we've also included some ETFs that you may not be so familiar with that we've launched very recently. So Drive, exposure to electric vehicles, iBuy, iGame, iBuy, iPay, and Game. And then also there are 4 thematics which we'll be bringing to market very shortly. They are future of food, digital health, solar, and metaverse, and they'll be very exciting exposures, and we look forward to bringing you more information on those. I'm not going to go through the investment case for each and the market dynamics, rest assured, but I do want to just touch on some of the interdependencies and enablers, and just quickly look at how quickly a few of these themes are growing and the potential for their addressable markets. Start with e-commerce. World's largest shopping event is China's online Singles Day, and this is just phenomenal in terms of the statistics. Each day within this shopping period, there's around about 1.2 billion consumers going on to China's major e-commerce platforms, and they're buying products from around about 5 million individual vendors. Alibaba alone has around about 2.3 billion online orders during this period. So you can just imagine the amount of coordination and the data required to process these orders and to get all of this shipping done subsequent to the sales period is quite amazing. We sort of see that e-commerce providers like Amazon, like Alibaba, through their own internal need, have really needed to build out the capabilities enabled to capture, store, and analyze data. Alibaba in about the year 2000 was an online bookseller, was looking to expand its business, and to do that needed to build scalable IT infrastructure to support that growth. It then started renting out that space to vendors who were selling on Amazon.com, and AWS, their cloud business was born. Today we create a lot of data. Data's growing at around about 60% per annum. Now, a lot of that data is increasingly being stored in the cloud. The cloud actually has a physical location. It's not just sort of a made-up place in the sky. The cloud's data is physically stored in servers within data centers. And the largest of those data centers are called hyperscale data centers. There's about 600 of those scattered around the world, the largest of which has a real estate footprint, which takes up just over half of the entire Melbourne CBD. So these are very big pieces of real estate. And in order to cope with the increasing generation of data, we're going to need to build about 100 of these data centers over the next couple of years. That growth in data, of course, creates opportunities. So opportunities for exploitation, cybercrime. Last year, about every 14 seconds, a business was a victim of a ransomware attack. And we see there, the extreme growth in the cost of these ransomware attacks. So since 2015, about a 53 times growth in that cost. Fortifying your business against cybercrime has gone from a discretionary part of the IT budget to compulsory, and it's actually the #1 area of growth and the #1 priority for chief investment officers these days. So that growth in data has also created opportunities for innovation, and we think about artificial intelligence. So cloud computing allows cheap, powerful computing and allows us to efficiently store, manage, analyze data, really big sets of data. That's really been crucial for that acceleration in artificial intelligence. And artificial intelligence is used in factory automation. Now, there is some resistance to factory automation and robots replacing humans in terms of jobs, but this also addresses a key demographic challenge that we see here. And I've got some statistics on China and their working age population, but working age populations in the West and in China are going to fall substantially over the next 30 years. So in order to preserve our current standard of living, automation and artificial intelligence will be crucial for that. Then we see how artificial intelligence is making great strides in the development of autonomous vehicles. So autonomous vehicles are being tested in the States, and each year we see that the amount of mileage covered by a vehicle before the test driver has to take the reins is growing by up to 100% per annum, which is incredible. And this just wouldn't be possible with that data, which is being stored and analyzed in the cloud. Within electric vehicles, the battery makes up about 25% of the total cost. And artificial intelligence is being used here in terms of optimizing fast charging. So, analyzing all the data around usage and recharging, looking at how best to charge that battery in the quickest means without harming the battery life, given the valuable asset that is within the car. And finally, we see how electric vehicles are going to revolutionize our energy infrastructure. We've seen they've created a shift to home solar and distributed energy. They also create the possibility, once we have enough scale in the amount of EV batteries parked in people's houses, to be used to help manage load on our electricity grids through a technology known as vehicle to grid. And this could be a real game changer going forward. So themes are interesting, they're very exciting, but please don't buy an ETF because of the name, except for maybe hack, because the name of that ETF is just too good. Or particularly, don't buy an ETF based on the theme it purports to get access to. You really want to do your homework here. Look under the hood, look at the stocks within the portfolio, look at the index methodology. Is it true to label exposure? Is it getting access to pure play companies, or is it just a sort of diversified broad market tech exposure? Ask the ETF provider for information on holding overlaps with broad market indices or on correlations. Ask them for information on what are the drivers of the industry, what are the enablers. Form your own opinion on the long-term strength of the theme and that addressable market that will exist for that particular theme. Generally, when I'm looking at thematics, I look for revenue growth. I find that more useful for earnings growth in the long term. And typically we see, broad market indices grow have revenue that grows roughly at the rate of GDP growth. Whereas what we obviously want to see with thematics is a step up in terms of revenue growth. And I just show some selected exposures that we have here and their relative revenue growth for 2022. Now, I do want to talk through just a brief example of portfolio construction and how thematic exposures might be used. So going back to that earlier example that I showed on screen of 3 satellites, which are Earth, Hack, and Drive. And the first point to note here is that, as I said, volatility within thematics tends to be higher than broad market exposures. So if I compare that to MSCI World exposure or country world exposure and Australian equity exposure, we see that step up in volatility. But what is interesting is the correlation difference. So we see here MSCI World and the ASX 200, despite being different geographical exposures, have a correlation of about 0.8. Whereas the correlations of these thematics to those broad market exposures are generally much lower. So that's interesting. Now, to take 3 example portfolios, we'll start with that high growth profile exposure where they don't have any satellites. We've just got 45% international equities, 45% Australian equities, 10% in defensives. We can see the return and volatility metrics over the 3-year historic time period here. Portfolio B shows what I consider a relatively small allocation to thematic exposure. So we're just putting 2% in each of these exposures, taking that from our core equities. We see firstly the step up in volatility. Now, I would argue that's pretty immaterial in terms of the change of the overall risk profile of your portfolio. Now I step that up to a 4% allocation in portfolio C to each of those thematics, which is representative of the illustration we had earlier in the slides. So that's 12% to thematics. And again, a relatively small step up in overall portfolio volatility, but the difference in earnings or in total returns is actually pretty sizable for a 12% allocation. As a result, that Sharpe ratio, due to controlling for volatility and having that upside return potential, that in this case gives us a very strong risk-adjusted returns benefit. So this is how we look to add thematics into portfolios, and this is where we think it really helps in terms of ensuring you've got that core right, but then adding that potential as satellites. I'll now invite Blair to talk about some of our new thematics and indeed some of our most popular ones today.
Yeah, thanks, Cameron. Look, it's really interesting to see the impacts, not only from a returns basis, but also a risk-adjusted returns basis that implementing some of those thematic funds across diversified portfolios can bring. So thank you for that. And also the correlations are also a factor I don't think we potentially take enough of a look at. And I think that slide really summed it up nicely. But to just, I guess, move into the exciting range of thematic ETFs that we have, and also some of the more relevant ones that are coming soon, I think it's going to be a really exciting year for BetaShares in being able to offer thematic ETFs. And Cam, if you just go to the next slide, beyond broader technologies, we've got a range of ETFs that offer specific exposure to themes which really sit at the juncture of the megatrends that Cam you've just explained, which could enjoy long-term structural growth. So in the near future, and what we don't see on the screen here is we'll look to offer strategies within the metaverse space, future of health, solar, and decarbonisation for a start. So areas that I think represent really exciting forays into what the future looks like. But then we also have a selection of existing thematic funds available here on screen. And obviously this will continue to grow over time, but just to highlight a few key ones. I mean, Cam, you mentioned HACK and the attractive name, absolutely, but it really stacks up from a fundamental basis, as you said. And I think, people can really relate to the fact that one, it affects us on 3 levels, right? The individual, so we need to protect our own, bank accounts, share trading accounts, and even health information via cybersecurity. 2, we own businesses, we work at businesses, and we need to protect the intellectual property in those businesses and be conscious of the way we connect with each other when doing business-to-business work. So I think from a business point of view, cybersecurity is also a very promising business case. And then number 3, at a government level, protecting state secrets, these types of things, and even, health data with vaccines and things like that, it's becoming more and more important for the government to spend money on cybersecurity. So when you look at the business case for something like HACK, the top cybersecurity names in the world like FireEye, CyberArk, Cisco, I think, looking into the long term, these businesses are going to increase their revenue. It's relatively sticky money, even if the economic cycle goes into a recession. People are still going to be needing to spend money on cybersecurity. So from a thematic point of view, one of my favorites, and also something that's stacked up over a long period of time. You've had that over 5-year track record, and in excess of 20% gains per annum, which doesn't indicate that that'll happen in the future, but exciting in terms of growth going forward. Another one to look at, which is again very exciting, is Earth, which aims to track the performance of an index comprising of a portfolio of 100 global companies that derive at least 50% of their revenue from products and services that help to address climate change and also other environmental problems. So looking at companies that are really at the front of the foray into decarbonisation and making the world, I guess, a place where it is cleaner and easier to embrace green technology and do the right thing by the world. So companies in there like Tesla, Zoom, which comes under a telepresence screen, so not getting on a plane, but being able to connect with you today via computer to talk about different ideas. So that's actually tangible in the way we don't emit carbon. I think it's a really interesting ETF to almost back your view in terms of where you think the world's going and do the right thing by the planet. And look, I won't touch on all of them, but another really interesting one that did just get released is GAME. So that aims to track the performance of an index providing exposure to a portfolio of leading global video, game and esports companies. And I think, we've all seen the growth of esports over the last couple of years, filling stadiums the size of Etihad to play computer games and get competitive with that. So very, very big market. And to put that into some perspective, the entire esports and video games industry is now larger than the US movie industry and the US sporting industry combined. So when you think about that and you think about US sports and the size of dollars that brings to the US economy, gaming and esports being bigger than that and the movie industry in the States as well together, I think represents a really exciting investment opportunity. So please reach out to your relationship manager if you have any questions on any of those solutions that we've mentioned or some that are there to come, because we're more than happy to provide information for you on that. And we certainly think that thematic investing is going to grow very, very quickly over time in Australia, as it has done over the rest of the world. So Cam, I just want to jump to the next slide. I mean, I think it's certainly important to consider some of the risks that are involved in investing, and I'll leave that with you for your own time. But the other thing I wanted to highlight is just the range of opportunities to engage with BetaShares as a business, and you've got some of them there. Our insights documentation and also our Bassinets Bites weekly newsletter put together by David Bassinets is, I know, much loved by the community, and I'd certainly encourage anyone who's not subscribed to that channel to do so. But also please ask us questions via Facebook, Twitter, or LinkedIn. We're more than happy to answer anything you need. And obviously as well, please reach out to us as your relationship managers if you do have any questions. We're now going to move forward into a little bit of a Q&A, and I can see some questions popping up there, but please, if you can see on your screen, there is a questions bar. Just type your question in there if you haven't done so yet, and we'll get to them shortly. But Cam, there is quite a few coming through. I'm just having a look here. Bear with me 2 seconds. Here's one for you, Cam, if you're happy to stick around for a little bit. With the ongoing narrative around rising inflation and corresponding rising of interest rates, along with the US Fed tapering, or tapering moves, what's the outlook for your many thematic tech stocks? Understanding volatility will reign supreme, but do they have a future for positive performance in the next 12 months? So I guess that's covering a little bit of what you went through, but if you've just got a 1 minute quick answer there.
Yeah, look, okay, so a lot of that driver was obviously from what's happening in fixed income markets. We've seen that bond yields have increased substantially, and they're now pricing in a very large number of rate increases, both Australia and the US. And that's now factored into equity valuations. I mean, we've seen that. The question as to whether or not we see valuations compress further or in fact reinflate, I think is a very difficult one to answer. I don't think I've got a crystal ball or anyone else does. I've got my views, but I guess just drawing back to that point earlier, we do see that market sentiment and also changes in bond rates can have that short-term impact. For mine, I've always looked at these thematic exposures as a long-term play, and that's really just drawing back to the comment I made on that slide about focusing on the earnings. Because if the earnings don't play out, then you've got a much greater problem. But sort of as Warren Buffett sort of says, you can afford to buy a high quality company for a higher price because it'll earn its way out of it, any holes pretty easily. So yeah.
No, that's great. Thanks, Cam. Another one coming through here, I'm happy to take. Can you tell us what else BetaShares is planning on releasing in the thematic space? So absolutely. Metaverse is one that we're certainly looking at. Solar, decarbonisation, and future of health as well. And there may be others, but I think in terms of what we're thinking about at the moment, they may be some that we look to release over the next 6 months or so. And certainly, you know, we're more than happy to take your ideas and have a look at the business case for that. So, you know, as I said, please engage with us and let us know if there is any thematic type of exposure that you would like to see out there in the market. Cam, another one coming through that potentially is for you. Are ESG ETFs too heavily weighted towards tech shares, given that they generally have a higher ESG rating?
Yeah, okay. Look, maybe I should just differentiate between thematic ETFs that have some form of exposure to climate change versus broad market. So if we take, for example, Earth as an exposure, which is obviously leveraging the need to decarbonize the global economy, they, you know, because a lot of the solutions are technology driven, we do see you know, a reasonable allocation to technology within that index. I think industrials are in fact the highest sector within Earth's index. Technology may be second or third. That's very different. That's sort of a, you know, a deliberate tilt that you want to take to access that theme, and that's why you have that as a satellite exposure. We also have a series of core ESG exposures. Now, you know, we screen on, you know, number of very important characteristics. Where you can see a tilt, say for example within our funds, is that we're specifically excluding you know, those companies, a lot of companies within the energy sector that have exposure to fossil fuels, which means that you generally end up upweighting other sectors of the index. Now, we specifically within ETHI, for example, control sector weights such that the sector weight, each sector weight within ETHI's final portfolio could be no more than 3% of the global you know, equity market. So it's about employing controls, and when you're looking to screen from an ESG basis, screening within industries or within sectors to try to reduce any natural tilts you might have to low carbon technology companies, for example.
Nice, Cam. I've got another one coming through here. Why don't you create an ETF that has exposure to the global art market? I mean, it's a fair question. We've discussed it, I think, at a very basic level. I think one of the headwinds there would potentially be liquidity, but certainly something worth exploring. Another one that's come through, are you thinking about releasing a thematic SMA? That's a really good question. It is something that's come up quite a few times and something that we're looking to explore, but certainly nothing concrete at this point in time. Cam, just having a look, do you have any insight into future disruptive areas that we should be paying attention to?
Yeah. So, I mean, the two sort of key areas that we're continuing to look at are the growing digitization of the economy. So, if you like, themes within that space. And the other area is the applications of technology in real world examples to solve issues around climate change. We do know that that's going to be a multi-decade theme. And so exposure, essentially, real world technology applications and also exposure to key resources within that space. So they're the two sort of key areas we think going forward are going to be crucial.
And Cam, thanks for that. It's a good answer. Is there much overlap in the thematic suite between different technology or environmental companies? So I think that's probably one for you.
Yeah, technology and environmental companies.
Yeah.
So, I mean,
well, just overlap in general.
Yeah. Okay. Look, I have included a slide in the appendix, which will be available to you, once the webinar slides have been sent out. With regard to overlaps, we see here across our range of thematic, very detailed slide, so I didn't want to go through this during the presentation part, but we can see here in grey, the stock overlaps between specific funds, as well as the NASDAQ 100, MSCI World, and ASX 200. So that's the top sort of right quadrant of this table. And then the bottom left is correlations. So you should receive this subsequent to the presentation today. But if we look at, for example, Earth's exposure, we see overlap with drive, which makes sense given that electrification of transport is a massive area of decarbonisation. So we do see some small overlaps there. Interestingly, the amount of stocks within each of these thematics that are held in the NASDAQ 100 is actually relatively small, due to the fact that our funds, we pride ourselves on being very pure play and not just giving people broad market tech for our thematic suite. Also very interesting, and you'll get this, is to look at correlations. I can't emphasize that enough.
Just scrolling through, mate. Thank you for that. Couple I can touch on. So will these funds have research reports available? Absolutely. With the new funds, we're just waiting on those reports to come through, but we'll absolutely have them. And for all the funds in there today, there is a research report available or coming over the short term. Another one here, my clients are keen on cryptocurrency exposure, but I'm concerned with the lack of regulation and nature of the way these are bought and sold. Are there any options? I think Crypt's one there that certainly is an option, where it's less about taking a cryptocurrency exposure, but building on companies that have exposure to cryptocurrency, whether it's through Bitcoin or coin mining or cryptocurrency exchanges. So it's a way to gain exposure or correlation to the cryptocurrency market, whilst investing in companies that are listed on stock exchanges around the world and derive revenues from their business activities. So maybe a way to play that space without playing cryptocurrency directly. So I think that's interesting, and that's a really good question. Are you able to provide PE multiples for the basket of stocks that you provide? So I guess that's talking about the ETFs that we have available. If you go on our website and look on the fact sheet, all the PE information is made available on the fact sheet, so that's definitely there. Cam, just going through a couple more that are coming through. Given some of these themes are relatively niche, okay, is there any protection built into the funds to combat lack of liquidity in certain markets?
Yeah, so I mean, fundamentally, one of those key criteria that we look at when we're looking for a theme is to ensure that we have an investable universe. And so a lot of work is done to appropriately, I guess, size constituents within the fund, look at liquidity, look at market capitalization of the stocks that are going to make a thematic index. It's a lot of work that we do up front. We also monitor this on an ongoing basis. These funds are generally, quite diversified across a wide group of stocks. So we tend to find that, we're very conscious of that being an ETF provider. Liquidity is key, that we build for that. We did see that, a good indicator of liquidity can be the spreads, which are quoted on, it's not the only indicator, but spreads quoted on market for ETFs, and spreads for our thematic ETFs over the period from March 2020 were reasonably tight given the level of volatility in markets. So as a proof point, we think that indicates that we've addressed, sort of liquidity structure within market microstructure.
Great. Sorry to put you on the spot here, mate. Another one coming through on China. Given China's in a different stage of the economic cycle, potentially to much of the wider developed world, do growth stocks in Asia present a way to gain exposure to technology without potentially the rates headwinds we've seen elsewhere?
Yep. No, that is a great question. So China, unlike developed market countries where we've seen a tightening stance from central banks, in China we've actually got an easing stance, and we've seen that equity price returns in China have almost decoupled from the rest of the world, so their correlations dropped. And this is sort of quite interesting from a portfolio diversification perspective, if nothing else. When for example, technology stocks or growth stocks were selling off in developed markets in January, Chinese equities actually sort of held their value pretty well. Does that represent an opportunity? Of course it does. Like the valuations of these stocks are sitting much lower than other spaces within the equity markets. The reason why they are cheaper in terms of their valuations is market sentiment. What we would need to see is a shift in sentiment in terms of stronger belief from the market around the policy outlook. And we think that is likely to come some stage this year because the underlying businesses are still very much intact in terms of their growth. So it's certainly a very interesting way to access growth. It gives diversification. There are a lot of supports that the Chinese government is putting in place for equities in China. So absolutely worthy of consideration.
Thank you. And I think there's just one final one here. How to think about percentage allocations to thematic ETFs to balance risk reward. So I think you touched on that. It might be worth going back to the slide even, but any commentary there?
Look, yeah, so I mean, fundamentally, when you're building a portfolio, you're trying to maximize your potential expected return for the risk tolerance of your client, right? So it's either whether you're looking at risk of drawdowns or volatility as a measure of risk, the sizing of particular exposures should be based off that. So some clients will have a greater risk tolerance. In that case, you can afford to have like larger allocations to thematics, for example. So it's very much client dependent. For this sort of question, we get this all the time. Please reach out to your BetaShares representative, and someone in my team or that relationship manager can talk you through that. And we can provide modeling in terms of what your current portfolio looks like and how it could be complemented by particular exposures.
Cam, one more that's just come in, and again, interesting in the sense that it's very topical at this point in time. Just any commentary on the impact, potentially of the Ukraine-Russia crisis could have on liquidity. And I mean, I'm happy to touch on that as well, but keen to hear your thoughts.
Yeah. So unquestionably, that's creates generally a bit of a risk-off concern. We have seen, for example, interest in one of our sector ETFs, fuel, which is exposed to obviously global oil prices for obvious reasons. Another one that actually sort of flies under the radar is our global agriculture ETF, food. Around about a quarter of grain exports globally come out of the Black Sea through Ukraine or Russia exporting. So there's certainly some tactical bets that are to be had in terms of that, of looking for exposures that may well in fact benefit or create some hedge for instability globally. Typically for thematic exposures, I sort of don't necessarily say to play thematic exposures due to an event such as that. I mean, you could argue that cybersecurity might see a boost given some of the cybersecurity attacks we've seen on the Ukraine, but I typically look to something like food or fuel as a way to play that if that was something of interest, or in fact QAU, which is our gold bullion exposure.
Yeah, thanks, Cam. And I'll tackle the liquidity part of that question. So really, we don't expect any liquidity issues with respect to the trading of ETFs. The common rule of thumb really is you are as liquid as your least liquid security in the portfolio. So as long as the market that you're investing in is liquid, you should really have no concerns in liquidity with respect to ETFs in certain market conditions. But I think that's all the questions that have come through, Cam. So look, big thank you today for that presentation. I mean, fantastic content. I think the case for thematic investing has never been clearer, and I think I'm personally excited about some of the different strategies. But yeah, thank you very much. As I said, for everyone joining again, thank you for coming along today, and really appreciate your questions. Please keep them coming through. If not now, then through your relationship manager or through our social channels. More than happy to reach out and give you as much information as possible. So thank you once again, and have a great day.
Thanks, everyone.